Hey all, welcome to ShareTreck. This is Raj here. Friends, if you recollect, very recently I made a video on BEAM Therapeutics and I was upbeat about the prospects for BEAM. Especially I was very impressed with Escape platform, and I was thinking that that's going to be a big differentiator for BEAM. And I also think that base editing being safer and more accurate than CRISPR-Cas9 is going to be a superior technology and will be adapted going forward. In all those cases where limited number of alleles have to be knocked out or knocked in. So those kind of thoughts gave me a bullish feeling. But today I have uncovered something which is a little bothersome, and that's what I want to discuss. Let's get started. Welcome back, friends. Today I saw a report in Yahoo Finance that gave me a bit of food for thought. I thought I should share this with you while I'm trying to investigate and validate what is being said in this article. So please bear with me. This will be a very short video. Just hold on. So here we have this article in Yahoo Finance which says BEAM Therapeutics analysts are cutting their estimates. Here is what you need to know. It says that the results were impressive, with revenues of $378 million exceeding analyst forecasts by 303% and statutory losses by $1.72. So this is spectacular returns over and above the expectation, 303% above. So naturally the price jumped up and naturally we all got bullish. So following the results, the analysts have updated their earnings model, and it would be good to know whether they think there's been a strong change in the company's prospects and or if it's business as usual. So here they are saying, taking into account the latest results, the 12 analysts covering BEAM Therapeutics provided consensus estimates of $67.2 million revenue in 2024. And remember, it was $378 million in 2023. So it's going to fall down to $67.2 million in 2024, which would reflect a substantial 82% decline. And losses are forecast to balloon 227% to 5.51 per share. So that's going to be significant loss EPS. And before the latest report, the consensus had been expecting revenues of $72.6 million and $4.55 per share in losses. So losses are forecast to balloon to $5.51. If you compare that with what they had been expecting, which was $4.55 per share in losses. So the losses are more than they expected. And so things are not looking great from the analyst perspective. And this could lead to a lot of downgrading. But it says here the average price target was broadly unchanged. Now the question is, if they have reduced the earnings, why would they leave the price target unchanged? And that's exactly what confuses me. Was it a mistake that they released their earnings estimate and then discovered that their earnings estimate were way negative than what was already done? Or maybe it was an inadvertent mistake in releasing the earnings estimate before warning their clients. Because now if they go and say that prices are downgraded, coupled along with this decreased expectations, significantly decreased expectation of revenue as well as EPS losses, then the share price is likely to tank a lot. Now that's what made me get concerned. And that's why in this video, I'm just pointing you to this article out here so that you can read it, form your own opinion. In the meantime, I'm going to be searching to find what is the reason why the analysts decided to reduce revenue significantly and also to reduce the EPS more than what they expected after such a sterling performance, due to which the market rewarded BEAM by pushing the share price up significantly with a huge gap up. Now, if the analysts are right, then I think it would be important for the analysts to inform their clients that they have downgraded the revenue. And as you guys know, when revenue is downgraded and EPS is downgraded, then the share price has to be downgraded. So there is a bit of inconsistency here in this report. And to be on the safer side, like I don't have any BEAM shares, but if I had BEAM, I would have two options. One is to sell it as soon as possible. The other is to do a covered call. Of course, this is my personal opinion of what I would do. It's not financial advice. So I would request that you do your own due diligence, look at this Yahoo report and do your own digging. and find out what's happening. As soon as I find some information, I'll make a video and let you guys know. So that's all I wanted to tell you. And I'll catch up with you again in the next video. Bye for now.